everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. Pre-FOMC, a different type of taper. Following last week's hotter than expected CPI release, the sole focus for the money and bond markets was to dial back yet again their Fed rate cut expectations. However, there's another aspect to Fed policy decision making that's been flying under the radar, and it involves their balance sheet. And with the May 1st FOMC meeting only 2 weeks away, I thought it would be a good idea to discuss this part of monetary policy because at this point in time, it appears as if this facet may make headlines well before actual rate cuts do. So what exactly am I referring to when talking about the Fed's balance sheet? Well, the simple answer is the securities held outright line items. And for a little Fed balance sheet 101, it's also known as the System Open Market Account, or SOMA. And the reader probably is more familiar with the terms quantitative ease, QE, or quantitative tightening, QT, when addressing the Fed's balance sheet. So recall that while the policymakers were busy implementing historic rate hikes during 2022 and part of 2023, they were also reducing their holdings of treasuries and mortgage-backed securities that ballooned in size as a result of the COVID-related QE program. Now, it's this latter portion of monetary policy tightening was QT. That's reducing their holdings of treasuries and MBS. So let's fast forward to the present. And it appears the FOMC is ready to start paring back the pace of QT, even if they are not ready to start implementing rate cuts. So let's look at the Fed securities holdings and try to get some perspective of how this current QT program has been working. At its peak, SOMA, remember that's their overall holdings of treasuries and MBS, and to some extent agency securities, but they're kind of marginal at this stage of the game. It reached as high as $8.5 trillion in May 2022. And since this round of QT went into effect in June of that year, total holdings have dropped more than $1.5 trillion to $6.97 trillion. So a little bit less than $7 trillion, at least as I'm talking to you here on this podcast. And the reduction is the result of the Fed's present plan to let their Treasury and MBS positions roll off by a combined $95 billion per month. I know a lot of numbers, but stay with me here, okay? Now remember, the Fed is not outright selling any securities. It's just not reinvesting the total amount of their holdings that are maturing or being redeemed. There is a big difference between the two. But based upon last week's release of the March FOMC minutes, the Fed seems to be considering reducing this aforementioned roll-off amount in half, and that could be coming out to, say, roughly $50 billion per month instead of the 95 that I just mentioned. In addition, it looks like the Fed's preference seems to be to pare back only the pace of QT that includes treasuries, not MBS. Interestingly, several Fed officials have gone on record that the ultimate goal would be to have only Treasury securities on their balance sheet. However, this could take quite some time. The Fed's balance sheet right now holds nearly $2.4 trillion in MBS, and the current pace of runoff here is $35 billion per month. So, while the money and bond markets await guidance on rate cuts, they may be getting another announcement as soon as the upcoming May FOMC meeting that a QT taper is on the immediate horizon instead. So I'm going to end it there. Have a great rest of the week, everybody, and be well.